This is Jody Trana with Chapter 2, Part 6 of Principles of Accounting, including a Chapter 1 and 2 review for the test. You're going to hear a lot about GAAP in this semester. GAAP stands for Generally Accepted Accounting Principles. Think about football teams for a second. What if the football teams on the West Coast had different rules than the football teams on the East Coast? Even if they played in completely different leagues, it'd be really difficult for us to compare two teams from either coast. They're operating under different rules. So we need to have common rules. And the same thing is true in comparing businesses. We need to be able to review financial information and know that that financial information kept accounting under some specific principles. So let's go through these four just today. First, the economic entity assumption. This assumes that the business's accounting is kept separate from the owner's accounting. That may seem logical, but many times when businesses get first started by the founders, there is a very gray area between what the founder owns and what the business owns. So those need to be kept separate. Second, the cost principle. This states that everything in accounting needs to be recorded based on how much an item cost, not what its market value is. Third is the going concern assumption. This states that we assume that the company has no expiration date. It is just going to operate on into the future with no foreseeable end. And fourth, the monetary unit assumption. This states basically that we measure all of our money in a monetary unit. I know it seems obvious, but we need to have these principles just to make sure that everybody's doing things the exact same way. In the United States, that means we use the dollar. We cannot take advantage of foreign rates just to make our financial statements look better. Here's a brief review of the account categories you'll find in the accounting system. Every transaction affects at least one of these categories. They are assets, liabilities, equity, revenue, and expenses. You saw in the previous movie clips assets, liabilities, and equity. So let's review those first. Assets are things with value owned by the company. The reason we own assets is that they are expected to grow the business and to bring in more revenue. Liabilities are others' rights to that value in the company. So assets have value, and people outside the company have maybe loaned us money or provided us with things that we haven't paid for yet. We have an obligation to them, so they have rights to the value in our company. Equity are the owner's rights to the value in the company. When we earn more money, when we put in more money as a cash contribution, our rights to the value of those assets increase. The other two accounts, revenue and expenses, indicate the money that we earn and the money that we spend for our regular course of business. The reason that these are in two different colors is to indicate which report these categories are shown on. Assets, liabilities, and equity are combined to show on the balance sheet, and revenue expenses are both put onto an income statement. This slide still shows our accounting equation, assets equals liabilities plus equity. But we're expanding the equity section a little bit to show you four accounts that are part of equity. The four accounts that are part of equity are owner's capital. That's how much the owner has rights to the assets. That's their contribution. minus owner withdrawals. That's money that the owner takes out of the business as a salary. And then revenue and expenses. All four of those accounts we can consider part of equity. You know how sometimes we feel that positives are good and negatives are bad? Well, debits and credits are not like that. Debits are not good and credits are bad. And debits don't always increase an account, and credits don't always decrease an account. How we record increases and decreases to an account is determined by the account type and the normal balance. For any given account, increases are recorded on one side and decreases are recorded on the opposite side. Assets are always increased with a debit and decreased with a credit. Liabilities are always increased with a credit because they have a normal credit balance. And equity also, these accounts are always increased with a credit because they have a normal credit balance. Whether an account is increased or decreased by a debit or a credit depends on the type of account and its normal balance. Let's take a closer look at the normal balances of the accounts in the equity section. We already learned that the normal balances of assets are debits and the normal balances of liabilities are credits. When you combine all the accounts in the equity section together, they should have a normal balance of a credit. Let's look at each one. Owner capital has a normal balance of a credit, just like equity in the accounting equation. Owner withdrawals has a normal balance of a debit because it reduces equity, so we have the opposite balance to offset the capital account. Revenue has a normal balance of a credit because when we receive revenue, that's sales, it increases our equity. It increases the owner's rights to the value of the assets. And conversely, expenses have a normal balance of debits because when we spend money, it decreases our equity. We talked about the two primary financial statements, the balance sheet and the income statement. There are a couple of other reports that we use quite a lot in accounting. One is the statement of owner's equity, and the other is the statement of cash flows. The income statement, as you can see, reports profits and losses. The statement of owner's equity reports the equity and what makes up the equity. The balance sheet shows our resources and our obligations, including our total equity. And the statement of cash flows shows a report of where the cash has come from and where the cash has been paid to through the period. One of the things that you need to understand is that 3 of these statements show information based on a period of time. That means you might see an income statement for a month. You might see a year's worth of information on an income statement. The statement of owner's equity you'll see for a year's period of time. And the statement of cash flows is probably most often for a month or a quarter or even a year. The balance sheet is a single point in time. That means we don't see a period's activity within the balance sheet. We see what we have and what we owe at a specific point in time, such as December 31, 2000. Here's another way of looking at the journaling and posting process. Step 1, we want to identify the accounts and the account type. Are we talking about assets? Then we know that the normal balance is on the debit side. Or are we talking about liabilities and equity? Liabilities are credit balances, and many of the accounts in equity are credit balances, although our withdrawals account and our expenses account are both debit normal balances. Step 2, we need to decide whether each account that's being affected, and we always have 2 accounts affected, at least 2, we need to know whether each account is increasing or decreasing. So we need to understand if it's a normal balance of a debit, we're going to be debiting that account in order to increase it. Step 3, we need to record the transactions in the journal. That means writing a journal entry, which we'll talk about shortly. Step 4, we post that journal entry to the ledger. And then step 5, we need to determine whether the accounting equation is still in balance. Remember that in our posting process, we are trying to post our journal entries and that activity into the actual accounts. So here we have a journal entry and our posting references. This indicates that we have already posted the $3,000 debit to prepaid rent and the $3,000 credit to our cash account. These numbers here are the account numbers associated with these accounts. Our cash account has the account number of 110, and our prepaid rent has the account number of 180. Let's look at it all together. Our posting process takes journal entry amounts and transfers them to the actual accounts. The journal entries are written in a book called the General Journal. All of our account ledgers are in a book called the General Ledger. We need to transfer our amounts from the General Journal into each individual account in the General Ledger. Here you can see that our cash account is account number 101, and we have debited it $30,000 in our General Journal. You can also see that that amount was added to our cash ledger in our General Ledger below. On November 1, we have a posting reference of J1. That means Journal Page 1. We have a debit balance of $30,000 with a running balance of $30,000. You'll notice that the account number 101 was transferred to the General Journal once that posting was complete. The second entry that we need to do is to take Bright Capital and the credit amount and transfer that into our General Ledger for Bright Capital. That $30,000 credit is transferred to our Bright Capital account of 301, that's our account number. We post the reference in our General Ledger Bright Capital account of J1, that is our journal page number 1, and we show that we have posted it by writing 301, which is our account number, back in the General Journal. That way, when we look both at the General Journal and the General Ledger, we can tell that it's cross-referenced and that we have posted it. The income equation is an important foundation to one of the financial statements, the income statement or the profit and loss statement. The income equation says that revenue minus expenses equals net income or loss, also called net profit. When the revenues are greater than expenses, we call it a net income. And when the revenues are less than expenses, we call it a net loss. The income statement reports the profit or loss for a company for a period of time, such as a month, a quarter, a year, or even a week. The header is important on the income statement, and it needs to read like this. It has the company's name, it has the statement of the financial statement itself, like here it says the income statement, and then the way that we report the date is important. It should say for an income statement, the month ended, or the week ended, or the quarter ended, or the year ended and then the date. You also see here that we have service revenue listed first. All of our revenue accounts will come first, and then our expense accounts. All of the expenses are listed in order based on the largest expense to the smallest expense. Net income is calculated at the end and underlined twice to show that the statement is complete.